Go ahead. What were you going to say, Mauricio?
Oh, we have our 1-year-old daughter that might be waking up, so my wife might be going in and out.
That's perfect. That's fine. Hey, good morning, everybody, and welcome. It is Saturday morning. This is Saturday Morning Unplugged. And we are live on Facebook, live on Clubhouse, and live on Zoom this morning. Hey, I am joined by my co-host, Moose. Moose, say hi to everybody, would you, today?
Hey, everybody. How's everybody doing today?
Great. Hey,
Happy
Moose.
Memorial Day week. Happy Memorial Day weekend.
Yeah, it is holiday, right? A little longer weekend this weekend. Great. We got a couple of great guests today, Mauricio and Princess Rouque from calling from Orange County, California, my most favorite place on earth. So it's heaven and paradise, right? I was just saying this morning how a nice walk on the beach at Crystal Cove might be nice.
Yes, sir.
Anyhow,
Good morning, Mike and Carl.
hey, good morning, Mauricio. Good to see you. So let me get all this out of the way. Like I said, this is a Saturday Morning Multifamily Unplugged. We are live on Facebook, live on Clubhouse. If you're calling in and you have questions, you have comments, you can use the chat on Facebook or use the chat on Clubhouse. A lot of people showing up on Facebook this morning. Good to see that. Hey, go wake somebody up. Today, we are going to dive into some raw, unscripted conversation. Who knows where we're going to go, what rabbit hole we're going to end up in, and how to try to get out of that. But listen, we want to get into our guests' history today and talk to them. So please remember, go and like us, love us on social media, Instagram, LinkedIn, Twitter, Facebook, and follow us, subscribe to us on YouTube. We're here every morning, or every Saturday morning, I should say, at 10 a.m. So we're going to bring some great conversation this morning. Good morning, Mauricio. How are you?
Good morning, Mike. Good morning, Carl. It's a pleasure to be here with you guys.
Why don't you tell us a little bit about you? And I know you and I have had a couple of interesting conversations since we've met, and it's been good to get to know you. Why don't you let our listeners know a little bit about you and Princess and how you guys got in this crazy world of multifamily?
Yes, absolutely. Well, my wife will be here any minute. We have a beautiful 1-year-old daughter, and so she's going back and forth, but she will be joining us very soon. But we both live in Orange County. I do residential real estate, and my wife is a full-time engineer. I know, Mike, that you're big on the why. I've seen a lot of your interviews, and you always like to dig deep on the why. So the reason we started looking into multifamily was simply because we wanted to spend more time together. Me being a residential real estate agent, I worked all weekends, and my wife worked a very stressful job, Monday through Fridays, 9 to 5. So we didn't really get a chance to spend that much time together. We love to travel, go out, and the time wasn't there for us. So we knew we wanted to look for something that brought some type of residual income. However, we didn't want to learn a new trade, selling juices or doing something different. We knew whatever we did had to be related to real estate. We just didn't know what. So through time and doing some research, we ended up running into multifamily, which made perfect sense for us since we were already in the industry, and it created, it seemed impossible, but at the same time, we met other people that were doing it, and that inspired us to get started.
Nice. And so how long have you been in the multifamily space now?
Well, I've found out about it. I discovered multifamily in March of 2019. I would say in July of 2019, that's when we committed to going full time or dedicating all of our time and resources into multifamily.
Nice. And you guys have some assets under management for just being in a short time, don't you?
Yes, we do. We have an 8-unit property here in Los Angeles, and we closed on 41 units in Kalamazoo, Michigan, about 2 months ago. And we have another one under contract, a smaller one in Los Angeles.
You're the GP on all those deals, aren't you?
I am the GP on 2 deals. I'm an LP on the first one.
Okay. All right, good. So, isn't it kind of funny how you get this fever, right? You get in the business, you start buying these assets, and all of a sudden you start to scale that business a little bit. It's pretty interesting. there's one thing about multifamily is that you get very passionate about it. It's almost like it was something in your DNA that all of a sudden comes to life. Hey, I want to say, tell Princess to bring your daughter on. She could sit on her lap.
I think she will. I think she's probably just changing her, but I think she will.
Okay.
Hey, this is unscripted, right? This is as unscripted as it gets.
Hey, listen, we never know where we're going to go, right? Hey, Moose, what's going on? You're quiet this morning.
Nothing.
What's up?
No, it's just I'm listening. It's really awesome. I mean, a lot of the people, Mauricio, that listen to ours, they're thinking about getting into multifamily, or they might have a small, a couple units. So it's always great to hear, somebody that's actually in action and doing it. You know what I mean? You're not trying to do it, you're doing it. And I remember the first building I bought was a 18-unit building. And, I look back now and I said, God, I wish I had a coach. I wish I had somebody to help me, through this, because I made a lot of mistakes, and then we went on to buy, I think at one point we had like 22 buildings. I lose count, but, we bought a 28-unit building and a 27-unit building. But, all of ours were in a local area. So I'm impressed that you're all the way in Kalamazoo. And I know Kalamazoo because I'm from Chicago, and that used to be part of my territory. But, I'm curious about how you found that property, how you analyzed it, and how you got it, financed and all that. So tell us a little bit about that story.
Yeah, well, we live in Southern California, and at first it's very difficult to find anything here. Here's my wife. So, yeah, they're asking about how we found the deal in Kalamazoo. So it's very difficult to find anything here in California. At least that's what we originally thought. So we started looking at different markets. One of the first markets that we looked at was Phoenix, Arizona. But Phoenix is extremely competitive. We were getting crushed in our offers. We were putting offers, we were getting outbid by not 50,000 or 100,000. We were getting outbid by 350,000, 450,000. So we knew we needed to look for something different. I started to analyze a couple markets, and through some connections, ended up looking at some properties in Michigan. And the moment I plugged in the numbers, Mike and Carl, it was incredible. I had been underwriting deals in Phoenix, and I couldn't make the deals work. And suddenly I plug it in the system, I start underwriting, I look at the expenses, and all of a sudden, oh, wait a minute, we have, we have returns. So this is great. And from then on, we started to build our team. We found a good property manager, lender, and so forth.
So let me ask you this: when you're underwriting a deal today, and for one comment I want to make is I think there's just a ton of opportunity in the small multifamily space. So that space you're in, under 100 units, 20 to 40, 20 to 60. I think there's a lot of opportunity in that space. But when you're underwriting today, tell me about how you're pushing rent. What does your rent look like going forward? Because I think some of these guys that are paying that much over what list price is, $300,000, $500,000 more than what the property's on the market for, may be hard pressed in a few years from now. But what are you doing? What are you doing on rent pushing?
I think the property manager plays a key role in this, because the property manager that we have is a gentleman that manages about 4,000 units, and he's very well recommended. He's the same manager that our mentor uses. He's the same manager that many of our lenders use. So when we talked to him, we wanted to be conservative, and he knows the area very well. So he was the one who was able to tell us, look, we can push the rents organically by this much. We can push them by, if we do these type of renovations, we can push them by that much. Initially, when I did underwriting, I would see that a lot, where people would just assume I can raise rents by 150, for example, but there's no real strategy behind it. And my concern was, what if we don't hit that mark? So to our surprise, we underwrote our deal at a
25-50 market bump rent
for 5 years,
for
right?
5 years, and that makes even just that 25 to 50 dollars makes a difference, on your numbers. It's not that significantly high when you're underwriting it at 100 and 150, of course, but that 25 itself can raise your, your NOI at a certain number, which still gives you a good return. So it depends on the property also when you're doing a market bump rents. because you want to consider what are the market rents and what the other apartments have when you're doing bump rents as well. You don't want to do an extravagant kind of renovation on one unit, and the next thing you know, you spend amount of dollars where you can really have that in return.
Yeah.
Right.
And I always say that you can raise rents $25 and nobody's really ever going to scream, right?
Right.
So just that
Yeah.
little bit really kind of helps in the beginning.
And I wanted to add something. We were very conservative on the rent bumps, and I had the chance to visit the property last week. As a matter of fact, a week ago, I came back to California, and when we saw the property and when we walked it, there's such a high demand for rents that the property manager said, "Oh yeah, this unit that's down, as soon as I put it back in the market, I could get 5 applications within a week at least $75 more." We thought, oh, 75, that's an extra 25 more than we underwrote for. So that was great.
Yeah. Hey, let me reset the room really quick. So just so everybody knows here, we are on Multifamily Unplugged Saturday morning. We're here every Saturday at 10 a.m. Central Time. We are live on Clubhouse, live on Facebook, and live on Zoom. If you are on Clubhouse, this is a listen only. And on Facebook or Zoom, you can put any questions you have, any comments you have in the chat. If you want to ask Mauricio and Princess any questions, feel free to. And if you want to try and wake my co-host Moose up, feel free to. So, hey, welcome, Moose. Good to see you this morning. How's it going? What are you going to do for the holiday?
Good.
That's what I want to know. What are you doing for the holiday?
I'm just going to hang out I have teenagers. I have 3 teenagers. So I'm just going to hang out with my kids. We'll probably go to the beach on Monday. My son always wants to play baseball, so we'll go find a park. He made me buy a bucket of baseballs, like 40 baseballs. So now every time we go, I got to pitch baseballs to him, but it's a lot of fun. So how about you, Mike? What are you up to?
Well, I'm moving. So my teenagers aren't answering the phone right now, which is no surprise to me, right? So, because they know I'm going to ask for help. So.
Right.
Okay. Hey, back to multifamily. Oh, go ahead. What were you going to say?
No, I was going to say, I never ventured outside of my territory. When I bought my buildings, they were all within, let me think about this for a second. They were all kind of in the same neighborhood in Chicago, right? They were all on the south side. We had a couple on the west side, but they were all kind of concentrated. And we did that by design because we had a certain criteria that we bought. We only bought corner buildings. We only bought vintage buildings. We bought buildings that had some retail on the first floor. We bought buildings that weren't more than 10%, roughly 10% studios. So they were like 1, 2, and 3 bedrooms, so that we could cross promote them. If one building was full, we'd always have a sign on all the buildings, a big banner that said, apartments for rent. And if someone called on one building and that building was full, we would refer them to another building because it was kind of in the same neighborhood, right? And Mike, I know that you were all over the country too. So I'm always impressed with, the fact that you guys go outside of your area, because I just never did.
Yeah.
And I understand what you're saying. I used to live in California. I know that real estate market is extremely competitive.
Yeah, you lived in the Bay Area, right?
I did, yeah. I lived in the marina there in San Francisco, which was crazy. I mean, that was in the 90s. But Mike, I know that you also like ventured out. So I'm always curious about that. Like, what was it like to take that first step? And Mike, I'd like for you to chime in too. But Mauricio and Princess, tell us what that was like. I mean, there had to be some fear, but around that, right?
Yes, there's a lot of fear at the beginning.
Well, I think first that we considered is the market. What's the price on the market? Because here in California, we all know that the market price is kind of ridiculous, and going out of state is more competitive. I mean, more. You can still achieve it at a minimum amount of money.
Get more for your buck.
Yeah. So I think that's one driving issue for us, or one driving, how do you say that?
There's definitely motivation for it.
Yeah.
Yeah, I think what also happened is that COVID happened between right in the middle of the one of our transactions. Our first transaction didn't work out. We got it under contract a week before COVID, and
Wow.
yeah, I was actually in Michigan on March 3rd, and our daughter was born on March 12th, and the lockdown happened on March 13th. So talk about timing, right? But what happened was a few months went by, all this uncertainty, and nobody knew what was happening. All lending was changing, the market was changing. There was a lot of fear, so that forced us into looking at networking a lot more. So we started networking, and now we actually have partners in Miami. We have partners that are aggressively looking in the North and South Carolina area. So we feel now that we've done in one part of the country, we feel that we have enough strength to open up or to start buying in different parts of the country just because of the networking.
Yeah.
Yeah.
So are these investors that you're talking about, are they asking you to go to different markets, or because you've got a footprint in Kalamazoo? I mean, have you considered buying other properties in Kalamazoo because you've got a good partner there, or what are your thoughts on that?
Yes, actually, the strategy that you mentioned, Carl, which is having more than one property in one area and having different asset classes in one area, that's what we're looking for. We just put an offer on 70 units on Monday. We got a counter offer that we have to underwrite to see if it works, but that's our goal. Kalamazoo is beautiful. Rent is growing fast. So we want to make sure that we expand our footprint there. That's where we want to stay. But at the same time, if we have some good partners, general partners in other states that find a deal in a different state, I mean, investors here, they want the returns, and they want to know that they can visit different assets in different places. So we're trying to cater to different type of investor, the investor that wants to buy within California, and the one who wants to buy in the Midwest, the one who wants to buy in the South.
Yeah, Kalamazoo's great. Eli Lilly's there, big pharmaceutical company. There's a university there. You know, it's right in the heart of Michigan. So, and most people don't even know, never even heard of Kalamazoo, but in the Midwest, right? But it's a good, solid market, So, Mike, and you were in some of those tertiary markets, right? You were in some of the markets that people aren't that familiar with, right?
Yeah.
Where did you own property?
Listen, a couple of the best deals I owned were in tertiary markets out in the middle of a cornfield where the cash flow was really good, But listen, I want to address your earlier question, which was why buy property outside of your area? Why go somewhere else? I bought that first deal was 11 units in the Chicago market. And I learned very quickly that it was overpriced and you weren't going to make any money in Chicago at the time, right? And I don't even know if you can do it today. I mean, I'm looking at deals and underwriting deals today, and we wrote an offer, and the seller says no because we're too much under his asking price, but you can't make any money if you don't come in. Your metrics have to work. But anyhow, I say in my book that I built a 4,000 unit portfolio from the coach seat of an airplane, right? Because I was in Dallas, I was in Alabama, the Huntsville market, long before Huntsville is what it is today. I mean,
it's a hot market now.
Yeah, it's a hot market now. I own some assets over across the river in Decatur, which was just outside of Huntsville, that were unbelievably great assets at the time. And I can't even imagine today what they are. But so I was in Texas, Alabama, Ohio, Indiana, and, one asset in Illinois. But that Ohio Valley, if you looked on a map between Indianapolis, Cincinnati, and Dayton, in that area there, we owned about 1,800 units there. And then the Alabama, and I had my biggest footprint in the Dallas market. But there was just better cash flow and better appreciation. What I could go in and buy at, have an all-in cost of $80,000 after my CapEx. In Chicago, it cost me 120, right?
Per unit.
Right. Thank you. So, matter of fact, somebody called me a couple of weeks ago, and he said, "Man, I just got off the airplane. I just finished reading your book." He goes, "Did you really buy that deal at a 13 cap?" I said, "Yes." He goes, "What do you think it's trading at today?" I said, "Oh, today it's trading at a 4.5, 5 cap at best, right?" So it just goes to show you the change in the marketplace and how you're effective, whether you're doing small deals or you're doing big deals, right? Either end of the spectrum. So
I just looked at one, Mike. I think I sent you the other day. A broker sent me 16 units, 350 grand a unit. 350 grand a
Wow.
unit. Now that's in Chicago, and it's a primo building. It's a premier building.
was that in
Um,
Lincoln Park, Carl?
I think it was in Lincoln Park or Rogers Park. I think I sent it to you, Mike. But yeah, I couldn't believe it. 350,000, 5.2 million was the price. I'm like, are you up?
Can you
Like,
imagine?
oh my God. I mean, I remember we were buying properties way back and they were, 30, 40,000 a unit. Now, granted, they were on the south side, but still, I can't even imagine. And these were 2s and 3 bedrooms. I mean,
Yeah.
but the rents are there, I guess, in those areas, but man.
So let me comment on that. All right. So here's the model, right? The model in small multifamily, 3 unit to 2 unit. And I think there's a lot of markets around the country that'll warrant this. But you go in, you buy something that is a C product, a lower end B product, a value add that you have to go in, put CapEx into, re-engineer, re-tenant it, and you're going to get out of it in a short time, 22 to 30 months. So this is what's happening. Lincoln Park, really more upper end neighborhood in Chicago. 6 months ago, a guy bought a building for $1.7 million. I'm sorry, 16 months ago, $1.7 million. And today it's on the market for 2.8. So he bought 6 units for $1.7 million, put 700 in it, and now it's back on the market for 2.8. And I'm looking at being able to try and do deals like that around the country where there's high rent growth, right? You got to go to the Phoenixes, you have to go to Tampa, you have to go to Houston and Dallas where the high rent growth is happening in order to make that model work. Talk a little bit, Mauricio and Princess, talk a little bit about your buying strategy and what that looks like when you're walking in, taking a look at a deal. What's your thought about your exit strategy on it?
Well, we have 2 different exit strategies, and it's interesting that you were mentioning areas with high rent growth, because the first strategy was buy, rehab, hold for 5 years up to even 7 years, being conservative, right?
Yeah.
We wanted to tell investors we could hold this asset up to 7 years just in case things go not as planned, based on everything that we were seeing with COVID. However, our strategy in California has changed because what we've noticed is that there's a lot of people that are buying outside of California and they're leaving a lot of deals on the table. What we're doing now with the property that we have in Echo Park is we bought the property. It had the same tenants for probably 10 or 15 years, which it was being rented at about, let's just say $900 per door. Now, after renovations, the rents in the market are roughly about $2,100. At a 4 cap, you can imagine what that does to the value of the building. So that's a new strategy that we're working on. So we're looking at exiting in 3 years on that one. We also have what is called the TIG strategy, which is to buy rental properties. Right now we have 7 units under contract. We will file with the city to turn them into residential, and we will sell them as individual condos. And that's about a 12 to 16 months exit strategy.
Yeah, that's great. And you know what? You bring up a very good point. There's opportunity everywhere, right? So, I mean, I'm a big believer of getting really good at one thing before you move on to something else and having a strategy. But with multifamily, having a couple of different strategies like you have, right? Because you found opportunities, and you mentioned some people are leaving deals on the table, which if you look at it creatively and say, okay, there's a deal here, right?
Yeah.
So how can we buy this deal where it makes sense? But then maybe like you said, repurpose the property or convert the property. A lot of times when I was a banker, we would look at vacancy rates and we would look at deficiency rates, right? And we would look at rents and say, well, yeah, this guy's owned this property, or this person's owned this property for 10 years. They bought it. The cash flow's been good. They've got good tenants. They don't want to raise the rents on them, but the rents are 10, 15% below market, so there's an opportunity there. And, when you keep your eyes open for that, you can find those opportunities. And the other thing is, Mike is a big, have you read his book yet, by the way, Exit Strategy? You guys have to get a copy of that. Have you gotten that yet or no?
We'll have to get a copy. Right now, we're reading the one from Derek Clifford, our friends. We like to read books by people that we know, the people that are friends that we have, or people that we look up to. So you're definitely next.
Hey, that's
Yeah,
how
you got to get a.
That's how we met. We met through Derek and Sophie Clifford. And
Yes.
I'm big fans of Derek and Sophie. They're having a great summer, right? They took a little extended vacation, and they're traveling and doing some crazy stuff. Good for them.
They're actually coming down here in about 3 weeks, so we'll get a chance to meet them in person.
Correct.
Yeah, nice.
Yeah. Weren't they on the show, Mike? They were on the show, weren't they?
Sophie was. Sophie was on the show that day with Julie, Holly, and Megan, and
Right.
But they were both on your Unplugged, because we watched it several times.
Yeah, they were. But my point is, you're looking at things, you're analyzing a lot of deals, which is part of what, Mike's a big proponent of that too, because you've got to look at deals. I mean, if you're listening to the show and you want to get into multifamily, even if you don't have the money yet, even if you're not ready to pull the trigger, start analyzing deals, right? Because that's how you're going to start to notice things. You're going to get your you're going to get your legs under you. You know what I mean? You're going to start to say, oh, this is what a deal looks like, or this is what, and that's really, really important. And if you don't have someone to help you through that, if you don't have a mentor, find a mentor or somebody that's got a lot of experience that's done that, because they'll show you what to look for, because you're going to look at 20 deals and then write a contract on one, right? I mean, that's just the way it is. And for those, if you haven't looked at 10 to 20 deals, you're not ready to do your first deal, right? I mean, analyze a lot of deals, right? And that's a very important thing, which you guys are both shaking your head, so I know you get that.
Yeah, and then just to add on that, when we first saw the numbers coming from the brokers, we're just like, okay, what are these numbers? Where does this number go?
How are we going to make it work?
Yeah, what are we going to put it? Or, does it comes with expenses? Does it comes with the income? How can we gauge what is a good deal and what is not? What is not? So when we saw these numbers, okay, we started to get more familiarized with the numbers. Okay, when we see the numbers that are from this category, okay, we know where to go. We can put it under expense, we can put it under income, we can actually consider it as an income in the future, or as an opportunity in the future. And that's what led us to actually really go through a mentorship program as well, because when we first saw the numbers, we were like, okay, maybe we can make it work. Maybe we can do this, that's just the maybes of a deal. And when we start looking into it more, we found, okay, if we see these numbers, we know now where to put it, but do we know what to do with it? Do we know how to make it work? Do we know how to put it up in a positive or in a negative way of a deal? So that made us that's when the coaching program makes a really big difference on us, because
and you can't believe everyone's numbers. I mean, the seller is putting their numbers in. You've got to run your own numbers, right? You've got to, you want to be conservative. I used to be a banker, so we were very conservative, because the bank is going to put in 60, 70% of the money. Well, they're not going to get involved in a bad deal. They're not in the business of owning real estate. They're in the business of writing mortgages, right? So, you have to run your own numbers, because the seller and the broker they're going to inflate the numbers or whatever. So, and I know, Mike, when you analyze deals, you use your own ratios for expenses. You use your own ratios for deferred maintenance. You use your own ratios for vacancy and for deficiency. So, and having a mentor, someone like Mike, that you can bounce stuff off of, is so critical. It's so important.
Yeah. And as a number person, you know right away where the numbers are wrong. You're kind of like, okay, 1 + 1, it doesn't sound 3, it doesn't look like 3. So you better need to run your numbers, really.
Yeah. The pro formas that the broker sends sometimes are not very realistic. We've probably underwrote a good 80 to 90 deals before we got the first one under contract.
Isn't it funny how the numbers are distorted? So I don't know what you guys use as a tool to put all the OM numbers in. But I find more and more that these offering memorandums are off by not a couple dollars, but thousands of dollars. And it's like, man, these brokers, and listen, I was a broker for many years. I get it. I get that, your job is to sell the deal. But listen, don't fudge on the numbers. Don't make things, because I find these mistakes and I go, oh, the OM's off by 25,000. Oh, the OM's off by 15,000. Look at this. How do you come up with these numbers? And then, it's almost like, do you think nobody's going to find them or what? I mean, it's beyond just a mistake. I'm sorry, but
well, they're selling the deal, and the reality is there's people out there. Listen, I bought a couple buildings that I overpaid for because I wasn't paying attention, and like I said, I mean, I get it, Mike. I'm not here to trash brokers either. My point is, as a buyer, you want to run your own numbers, right? You want to make sure that the expense ratios are in line. You want to make sure that the vacancy rates are in line, and all those if someone's saying that they can increase the rents, by 30%, you want to do your research and say, well, that means that they're significantly under market right now. So you have to do your own due diligence.
Yeah. And that's so true. And sorry, Mauricio, that is so true. I mean, that's why all those broker packages, all those offering memorandums all say on the first page, make sure you do your own underwriting, your own due diligence, and you find it, right? And as the more experience you get, the less time it takes you to find how they balance. So go ahead. I'm sorry.
I was just going to say that there's also a lot of people with money nowadays that they don't really care too much about the returns. There's people that are just trying to park their money somewhere. And I saw that it happening in Phoenix where it doesn't, I mean, I just couldn't make the numbers work. Not even, I was far off, yet I would still get outbid by like I said at the beginning, 350, 450. And the brokers would say, oh, these are people that are putting 50% down. They just want to park their money somewhere.
Yeah.
Well, it's true. And you've got, you're competing with the REITs, the real estate investment trusts, you're competing with the insurance companies, the Wall Street money. You've got 1031 people, that they bought a piece of property. So rather than paying 30% capital gains, they'll pay 10% more for the property just to, so they can get into it. So, and that's the key. I mean, you that's why it's so important to pick your strategy and stick with it, right? Because, and I've said this before, a piece of property is nothing more than a vehicle. It's like a bus, right? It's going to get you from point A to point B. If you miss this bus, just stay where you're at. Stick to your strategy, because you're going to find another property that's going to fit your strategy. So don't alter your strategy too much. Find the property that fits your strategy, as opposed to trying to alter your strategy beyond reason to fit the property. Because you're right. There's buyers out there that are overpaid, especially in Chicago, markets like Chicago. I mean, it blows my mind that a 16-unit building went for $5.2 million. I mean, it blows my mind.
That's like the price of brand new construction.
Yeah, right. Well, I don't think you can build stuff for that today, right? With the cost of material today, how much material's gone up. Here, I just tell this example, right? I have a buddy who is in a specific neighborhood in Chicago. He's buying these old bungalows and he's tearing the tops off them and putting a second story on them and a little addition and putting them back on the market. Well, he's got a great model, but one day I'm out with him and he says, look at this house here. I paid $16,000 for the material. He goes, this one here, my lumber cost me $38,000. How do you compete? So this is why there's such a demand on already built assets today, right? That's why the demand on assets is so high right now, because they're already in place, and you don't have to deal with the cost of goods to build something new that's kind of gotten a little out of hand. And what's funny is they're saying it's not going to go back.
Well, it's interesting because, for those of you that aren't paying attention to that, one of the reasons why that happened was all the lumber mills were shut down for a year. So they weren't producing any lumber. So the price of lumber is supply and demand. So I agree with you, Mike. There's going to be some correction, but it's never going to go back to $1.40 for a 2x4, when which is up at $7 a 2x4. So, those are the things you have to pay attention to, because I know a lot of people also that got burned on that. They're like, my numbers were tight, my margins were tight, and now my cost of construction went up by 40%. It's not going to work for them anymore,
Yeah. Just,
Yeah, and I know flippers are having a hard time with that as well.
yeah. Oh, geez. I didn't even think about them. Yeah. That must be that's gotta be a tough deal right now too, because your cost has to be distorted. Your model, there's always that model, right? Hey, if I can buy at 70% less of ARV, take my construction costs off, that's got to distort your model right now.
Yeah, I think so. I mean, we've talked to several flippers, and since we started looking at this LA strategy, we've seen a lot of interest because there's not hardly any deals out there. So when people are looking at, okay, we can invest instead of doing all the hard work and buying for barely any margins, now we can put the money into a rental property, convert it into residential, sell it as individual condos, and get higher returns without me having to do all that extra work. So this model that we're working on is really taking off, huh?
Yeah.
Yeah.
So can I ask you guys a question? One of the advantages that I had when I switched my mindset, because I had some really great clients when I was in the bank, and one guy would say, just write contracts. He'd always have 5 to 7 contracts going at once. And I said, well, why is that? I said, yeah, but what's going to happen, if you have to execute on all 5? He goes, no, I get to pick and choose. He said, you can always assign them, right? Well, one of the biggest deals I ever did was an assignment, right? We put 5 deals under contract, and we could only execute on 2 of them. And the third one was still a really good deal, and we assigned it, and we made more money on that deal. We never took title, right? We were never at risk, because the way the contract was written, we could get out of the contingencies. The person that came to we assigned it to covered our downstroke. I think we put up $75,000 for our down payment, and we charged them $100,000, right? So we weren't, even if we lose our earnest money because of them, we were still going to be ahead of the game. And we never touched the property. So, that's one of the advantages of putting deals under contract, because you can control the deal, right? Once it's under contract, you control that deal at very minimal risk, because if you write the contract correctly, you've always got a couple of back doors to get out of the contract. And so have you ever thought about that? I mean, do you guys write multiple contracts? Mike, I know you have, but I'm just curious to see what Princess and Maurice have to say about that.
Yeah, we do write multiple offers. Right now, we have 3 offers out for the TIC strategy, and we're doing a little bit of a different approach. I'm a real estate agent, and as agents, I'm sure you guys know, we don't have an exit strategy. We don't have a retirement plan, whether you're in the mortgage industry or just an agent yourself. You're just going to work until you're able to, right? And hopefully you have enough savings. So I have several friends and colleagues that are very motivated, that have really good work ethics. They're really good with clients. So I've talked to a few of my friends and told them, look, there might be a possibility for you to work with us in the future. And that way, if we get, for example, out of the 3 deals, let's just say we get 2 offers accepted, I believe we have the bandwidth to take on both. Now, if we got 3 or 4, probably not. But I think at this point, we have enough bandwidth where we can tell 2 of our friends, hey, look, there's an opportunity for you to jump in as a general partner with us now. These are friends that have already invested with us, so the trust is already there, and that's our strategy. So we're thinking about growing, and instead of leaving deals on the table, maybe the slice of the pie gets a little bit thinner, which is completely fine, but we can share more.
Yeah, and I think that's
well. The other thing is, you can go ahead, Princess. No, I was just say the other thing is you can assign it. You can wholesale it. In other words, you could just, if the deal's good enough, you can find somebody that wants to take that deal, and you assign the contract for, depending how big the deal is, could be $10,000, $20,000, $50,000, and you could assign it to them because you control that property. Now, I know the laws, every state, the brokers have different laws. In Illinois, you have to be a little bit careful about that when you're a licensed broker. But if you're not a licensed broker, it's a little bit different story. You're just operating as a private business person. And my point is, if you have that deal under contract and for some reason, you you can't take it down because you're doing other deals, you could always find somebody else that just wants to take it off your hands, and you assign the contract for, if you're buying it for 200,000, you assign it for 225, and you can make 25,000 bucks. So that's also a strategy to
Yeah,
consider.
it's always on the table. We have a good friend of ours who does that in Toronto, Canada, and we've talked about that also. So if we come across something that we feel that it's a good opportunity, or we have a good buyer, that's definitely a good strategy.
Mauricio, I like what you said about taking a little bit less, right? J. Paul Getty said that he'd rather have 5% of 100 businesses than 100% of one. And that's that strategy where, you've got a whole lot of opportunity coming from different areas. So, hey, listen, we need to start winding this down this morning, you guys. We're about 40 minutes in. Listen, Mauricio and Princess, any comments, anything that you want to leave people with, knowledge, information, suggestions?
And how do we get a hold of you? How do we get a hold of you also?
Sure, yeah. Well, you can visit our website at brickstoneinvestmentgroup.com, and there's a bunch of
links, and we have all of our personal information. You can find us on LinkedIn and also on Facebook.
Yeah.
I would say,
what was the website? I'm sorry, I want to put it in the chat.
Yes, sure. It's Brickstone Investment Group.
Bridgestone, right?
Brick.
Oh, Brickstone. Okay, I'm sorry. Go ahead, Brickstone.
Brickstone Investment Group. And what I would say, Mike and Carl, is in our case, we did look for a mentor because it's a very difficult business. You're finding someone to teach you a new trade, a new career. I know you guys, I know you might have a mentoring program, so I would encourage anyone that's watching to look into it, because knowing that we had that mentor looking over our shoulders made a huge difference. And we couldn't have done it without our mentors. So I would strongly suggest to those that are looking to get started to either find a mentor or find someone who has a mentor and leverage them and see what you can bring to the table. Hey, I can help you with due diligence. I can help you with capital raising. I can help you with whatever, but find someone who has someone overlooking at them.
Yeah. Thank you so much for that. I appreciate that. Hey, I've been in coaching for over 20 years, right? And I don't think you can ever learn enough. And, you keep expanding your mind. So that's great that you guys are in that mentor program and that you're learning. So thanks for that plug too, by the way.
Yeah. And Mike, you're not as young as you used to be. I tell Mike all the time. Yeah. No, but seriously, I tell Mike all the time, I said, Mike, you forgot more than what most people don't know yet. So, I mean, and listen, you and I have known each other a long time. I really do wish that I would have had a guy like you in my corner when I bought my first 5 deals, because I probably left on average $10,000 to $15,000 on the table for each of those deals. So, you're talking about $50,000 to $75,000 that I probably would not have left on the table if I had a guy like you in my corner, just looking over my shoulder and saying, did you consider this? Did you consider that? And little things like the age of the roof, whether it's a boiler building or individually metered, or, who's going to pay for the closing costs. I mean, for those of us that have done deals, there's so many opportunities to negotiate, and, $10,000 here, $10,000 there makes all the difference in the world. And Mike, you and I, we're both, I've probably invested $250,000 in coaching over the years between all my coaching that I've added up. And it's paid huge dividends. And the other thing I always say about coaching is, you pay for it once, but it's with you for the rest of your life. It's an investment in your learning. You pay for it once and you have it for the rest of your life. So anyway.
Yeah, for sure.
The other thing that I would say is very important about mentoring or having a coach is that I've met people at the beginning of our career and who were on fire. They were going to do everything. They don't have a coach and they're nowhere to be found anymore. So when you have a coach, there's that accountability. And even when you see that email come through once a month, it's like, you have to step up your game. So it's extremely important. It's not just looking at the numbers, is that commitment. And I would strongly suggest that.
It's definitely an investment in your education. It's an investment in your future. And how much money are you going to spend on your education each year annually, right? And one-on-one coaching for me has been the best education and accountability that I've ever had. So, hey, listen, we need to wind this down this morning. And I really appreciate you guys being here. Your wealth of knowledge, your excitement is contagious. There's no doubt about that. And I love the fact that you love education and you love coaching.
Oh, yeah.
And that's so great. So here's what I want. I want everybody to make sure that you watch your inbox in the coming weeks. Okay. We have a bunch of events coming up this year, things that you're going to be able to get educated on. I have a series of live webinars I'll be doing over the next 8 to 10 weeks. We have a live event we're going to be doing in Chicago this year in August 20th to the 22nd. It's going to be a multifamily mastery. I'm going to invite everybody to come out, and it'll be a 3-day event here in Chicago. But leading up to that, we're going to cover a bunch of topics. So we're going to do some live webinars along the way where we're going to cover multifamily fundamentals, due diligence, underwriting, things that are important in today's environment. How do we look at things from a conservative standpoint today, where we're not going to get caught up in a trap of being over our skis on a deal, right? And that's what we want to watch out for. So I just invite everybody, just keep an eye on your inbox. If you want any information, DM me. Hey, Princess and Mauricio, you guys, I would like you to go, you could grab a copy of my book. It's an ebook. It's My Core Intention, or go to mycoreintentions.com/exit plan. You can download that. If you really want a copy, just let me know and I'll send you a hard copy. So I appreciate
Perfect.
you guys being on the show today. Carl, it's always a pleasure on Saturday morning. So
Thank you both.
Yeah. Good to see you, Mike. Mauricio, Princess, wonderful to meet you. And by the way, your little girl is very quiet, so she must be sleeping. She knows mom and dad are working, so she's in there comfortable. But seriously, it's really great to meet you. And if I ever get to out to that way, I'll look you up. And if you ever get to Chicago, look Mike and I up. We'll go grab a cup of coffee.
We'll probably be there for August, hopefully.
Oh, good.
Or
great.
I know you have another event in October, if I'm not mistaken, the summit.
In October, that'll be virtual. That'll be we'll bring 20 speakers from around the country together on that one. So that'll be a good event too. So
Perfect.
yeah, I have a bunch of education stuff coming up this year.
Perfect.
So it's going to be great. And hopefully next year we're going to do everything live. So appreciate you guys this morning. Thanks for being here. It's an honor to get to know you and understand a little bit more about your world and that. And look forward to seeing you guys again. I know our paths will cross often. So
Absolutely.
For sure.
Thank you guys. Thank you both.
all right, guys, have a great day. Bye, Carl.